The last thing that I'd like to talk about now is learning objective 4-7, understand and explain the basics of push-down accounting. And when you see push-down accounting, you're like, wow, companies should always do that. But companies don't always do that, and there are reasons for it. What happens when you have a differential? And what we've been talking about so far is you account for it separately. In other words, you leave the sub alone, and the parent, the parent, leave the sub alone, and you record the write-ups and the write-downs in the consolidation itself when you book the consolidation. And they remain in that spreadsheet. So the books of the sub remain intact, and the sub keeps on going like nothing happened. And every time you do the consolidation, then you book the write-ups and the write-downs and the various things that are going on. And an alternative to that is push-down accounting. And what push-down accounting does is it goes back into the books of the sub, and it revalues the sub's assets at market value on the date of acquisition. So you actually adjust the books of the subs, and then this eliminates the need to record write-ups and write-downs in the consolidation. So the way this would work is you would go through each asset and liability, and you would create, you actually don't add to the assets or liabilities, you would create valuation accounts to increase or decrease the value, and you would put them directly into the books of the sub. So if there's goodwill, that will also go into the books of the sub. And then in this journal entry, you're going to be writing up all these assets. You might write some down, writing up the liabilities, maybe write downs, record goodwill, any other unrecorded intangible assets that might have happened that were recorded as part of the happened as part of the acquisition. And when you record that journal entry, inevitably there's going to be another line item that you need to credit, and that's going to be called revaluation capital. And you'll credit revaluation capital for this difference. So again, with non-push-down accounting, you don't do any of this at all, and you just record all your adjustments when you do your consolidation. So push-down accounting simplifies consolidation, and all companies can use push-down accounting as an option according to the FASB. And non-push-down accounting, again, you have this consolidation effort, which is quite cumbersome. But that's what we've been learning up until now. Push-down accounting is much simpler. And it really, in fact, it's so simple, I don't think I need to go through an example. The book value is going to be equal to the investment after you record your push-down entry. And consolidated financial statement amounts should come out exactly the same way, only your accounting procedures themselves differ. So with non-push-down accounting, you can continue to use the equity method. You could use the cost method. With push-down accounting, there's no point in adjusting the equity method for this additional amount. Remember, when we went up through the equity method earlier, we had 3 journal entries, one for income, one for dividends, and one to adjust income for the income statement effects of the differential. For example, we had additional depreciation, if you remember, for $6,000. With push-down accounting, the sub is going to write up the equipment to the full $360,000. Therefore, there's no need to record any additional amortization, and the parent can just use the equity method, and everything should work out perfectly. There's no need for additional adjustments on the part of the parent. So here they show it in another way, a graphic way. You have the sub's income statement and balance sheets are based on book value, and then the parent adjusts for them in the consolidation. With push-down accounting, everything is already adjusted for, and it's very simple and straightforward. And of course, students should like push-down accounting because it simplifies consolidation. But as one of my professors said, when I was a student, he said, we should want things to be complicated because then people need more accountants. And if we're going to be accountants, we obviously want to be needed. So we should want things to be complicated because that creates demand for more accountants. With that note, I will sign off on Chapter 4. Go ahead with the practice assignment if you want, and then go ahead and work on Assignment 4 and then Chapter Quiz 4.